Yeah, that's
Got
good.
a lot of juicy stuff for you guys on.
Yeah, well, on that note, we'll go ahead and get started. Thank you all so much for tuning in today. I am so excited to learn and dive into this incredible call alongside you. So, a bit of background information on our host. Rose is an online educator on investing for women, and she actually bought her first stock when she was 14 years old. Her prior work experience comes from a background on Wall Street, where she was the only female trader on the floor. And this made her realize how daunting it is for women to operate in a masculine financial world. So now she's passionate about leveling the playing field for women by helping them become savvy and confident investors. Her goal is to empower women to take charge of their finances, put their money to work, and be unapologetic in pursuit of wealth. And with that, we are obviously in unprecedented times, financially or otherwise. And while nothing is ever guaranteed, as we've so clearly seen in recent weeks, I'm so excited to take this hour to learn what's possible and to expand our financial horizons. So thank you so much, Rose, for taking the time to host this call. We know how valuable your time is, and we can't wait to learn from you today.
Awesome. All right, I'm going to share my screen and present the slides. Let's see here. Okay, Hannah, can you just confirm you see this?
Looks great.
Okay. All right, so today I'm going to be talking about investing your money, and as fate would have it, it's a really good time right now to start talking about this. And I'm going to be covering a couple things. I have a lot of stuff packed for you here. First, I'm going to talk about sort of what accounts to open and where, so actually how to buy investments and what you need logistically to be able to do this. And I'm going to gear it towards entrepreneurs because most of us are entrepreneurs here or freelancers, and the types of accounts you'd want to open are a little bit different, and you have to be more proactive about your own retirement since you don't have a pension or a 401k. And then after we talk about that, I'm going to go on and talk about what investments to put in those accounts. And specifically, we'll be talking about index funds because there's really a couple ways to invest. One is to pick individual stocks. The other is index funds. And I'm assuming everyone here is a busy entrepreneur and doesn't have the time to be researching stocks individually. So I'll talk about how to pick good index funds, what factors to consider when you're picking them, and also a holistic view of how you should think about your portfolio as a whole and how to combine different index funds to create a good balanced portfolio. And last but not least, I'm going to talk about sort of more the psychological, emotional barriers to successful investing, like fear and what happens in market crashes like this. And my goal is really for you to not just walk away with some practical, actionable steps on how to get started investing, but also to know what it takes to succeed and know what the evidence shows us is what you need to do, so that you feel confident about what's going to happen to your hard-earned money, regardless of what the market does. I think just knowledge really takes away fear. Fear is really because you don't know. So that's the last aspect of my presentation. A little bit about me. Hannah gave me a really awesome introduction. I look a lot better in that photo than I do now because that was like photo shoot day. Today is just work from home day. But I did dress up a little for you ladies. Quick background, I went to NYU and got a finance degree. I worked on Wall Street for a while, but after about 5 years, I got really sick of the corporate life. So I've gone off on my own since to become a solopreneur. And I didn't fall into doing this right away, but after some time of self-reflection and freelancing and doing random consulting, I'm sorry, my building is making an announcement. Ooh, okay. Where was I? Okay, so and now what I do is I coach people and teach people mostly via online, but also some live workshops about how to get started investing. It's ironic that I had to basically get a finance degree to realize that you don't need a finance degree to know this stuff, but I do think like really good actionable financial investing information for the average person is kind of buried under a lot of sales pitches and maybe like financial jargon that the average person can't really understand. So I'm really passionate about just empowering people with financial literacy so that they can make the best decisions for themselves. A lot of this comes from like personal experience. Like when I was little, growing up, I grew up in a very traditional Korean immigrant family, and the only values were hard work, education, get a good job, but nothing about financial literacy. And I watched my parents like fight a lot about money and make bad investment choices. And a lot of that I realized is because they lacked financial literacy and they were never taught how important it is. So that's sort of the reason why I do what I do. Also, I used to live in New York. Now I live in Denver. So if there's any Denver transplants from New York here, I would love to hear because it's a really different lifestyle. Okay, so let's kind of get into this. First of all, like before I dive into the meat of the presentation, I just want to frame like why are we all here? You guys are on this call because you know that on some level investing is really important. So I really want to just nail this down. Like it is important, but why? So first of all, investing helps you beat inflation. I'm sure you all already know what inflation is. It's when the purchasing power of your cash goes down over time. And you've probably heard that it all happens. You know that it happens because you know that gas doesn't cost what it used to cost 10 years ago. And a movie ticket is like twice what it used to be. And a latte is now like $5 when it used to be like $3. So you know that it happens, but I really want to drive home the impact of inflation on your money. Just in my lifetime, I'm 31. So just in my lifetime, the purchasing power of $1 has gone down by 50%, which means if you have the same amount of money that you had 30 years ago and you have that now because it wasn't invested, it's just, you know, $100,000 then, $100,000 now, that $100,000 is actually gonna only buy you $50,000 worth of stuff. So that's the impact. The average is about 2% per year, a decrease in purchasing power. So over time, from 30 to age 60, you can imagine what that will do to your financial security. And that's why investing is not just a nice to do, it is an absolute must. Because if you just stand still with cash in a bank account, you're actually losing ground. And so that's kind of the unfortunate reality. Secondly, it enables you to work smarter and not harder because I mean, like entrepreneurs, we're all about scaling and leveraging systems and not trading time for money and things like that. And investing is the ultimate way to do that because every dollar that you put to work is an employee that's working for you, earning you dividends, growing and helping you participate in the upside trend of capitalism without actually doing all the work yourself. And the type of investing index funds that I'll be talking about is very passive. Once you set it, you can literally just set it and forget it, and it'll continue growing and working for you. And just to give you an idea of how investing is working smarter, not harder, this is a table that shows where if you invested in the S&P 500 index, just $500 a month for 30 years, a very, very consistent $500 a month, 30 years. And I'm looking at let me just get my highlighter here. Oops. Pointer. Oh, here it is. Okay. So $180,000 after 30 years, that's what your total deposits have been. That's $180,000 of your own money. But the total value of your portfolio would have been almost $1 million right here, $959,179, which means that market growth actually gave you $779,000 of that money. So again, just to drive home this point, this graph shows the red line, which is how your savings are contributing, this $500 a month, year over year. And by the end of 30 years, $180,000 of your own money is in this portfolio, but your portfolio will be worth almost $1 million. So that's like a lot of free money right there. That's basically free money. And that's the definition of working smarter, not harder. Just because you put your money somewhere else versus in a bank account. So when I was running these numbers, I got really excited, and I hope you guys are excited too. Just give me a nod if this is exciting to you. Cool. All right, and the next reason is because obviously you can turn it into a nest egg that you can turn into income later on when you don't want to work. Usually like people retire around age 60 or whatever, but if you build a nest egg faster, you can retire earlier because you need something, assets to pay you dividends and throw off income. So that's basically why we're here. Oh, and just to give you a quick kind of rough back of the envelope way to calculate how much money you need to have saved up in order to retire the way you want to is the 4% rule, also known as the rule of 25. But basically it was based on this big study of historical returns of stocks and bonds done by this guy named William Bengen. And he basically concluded that the safe withdrawal rate in retirement is 4%, which means you need to have a nest egg that's big enough so that you can live off 4% withdrawals a year. And 4% is safe because the stock market growth as well as the dividends that you get in your portfolio are going to cover enough so that you can withdraw 4% and not run out of money before you die. So that's kind of how you can do a back of the envelope calculation of how much money you should work to have saved up. For example, if your annual expenses are $50,000 a year, you multiply that by 25 and that's how much you need to retire. Cool. Also, quick note about questions. As you have questions, because I know questions arise and you might forget if we leave them all to the end. So just drop them in the chat because I will see it, and then when it makes sense to answer it, I'm going to answer it because before I move on, I don't want to just plow through without taking questions. So feel free to just drop them in the chat, in the public chat. All right, so moving right along, how to get started investing. So the three like big steps are to first open a brokerage account. Then the second step is to choose investments to put in your brokerage account, because an account is not an investment. An account is an account, and you need to buy investments in it. And then the last is to place the buy order. So sounds a lot easier. That's basically it, but I'm going to break down each of these steps in detail. So step one, open a brokerage account. So I just mentioned that accounts are not investments. So many of you have heard of the Roth IRA. That's one type of account. When you open a Roth IRA, it's not an investment, it's just an account. And even if you've put money in it, it's still just an account with money in it. So you gotta I just want to clarify that accounts are not investments. They're like bank accounts, and you have to buy stuff for your money to start working for you. And there are a lot of different brokerage accounts that you could open. And I'm going to talk about a couple that are more geared for solopreneurs, freelancers, self-employed entrepreneurs. The first type, this is kind of a silly illustration I have to explain the whole accounts versus investment differentiation. Brokerage account is the shopping basket, and the stocks and bonds and index funds that you put in there are the groceries. So that's kind of my little very basic illustration. All right, so types of brokerage accounts. There's basically two main categories. The first is a taxable brokerage account. That's a very basic account where you open it, you put money in it, you buy investments, whatever you make on those investments, whether it's in the form of dividends or capital gains, you pay taxes. Whatever the going tax rate for those kinds of gains are, you pay them. Tax advantaged accounts are just by virtue of your investments being in that account, you get to avoid a ton of different types of taxes. Capital gains, dividend income, interest income, like you get to avoid a lot of taxes. So it obviously makes sense to invest in a tax advantaged way. Taxes are always should be a top consideration in how you invest your money. So if you don't have any accounts, you have nothing set up right now, you need to start with a tax advantaged account. And the best ones for entrepreneurs there's three kinds I'm going to talk about. The first is the Roth IRA. This isn't even just for entrepreneurs, this is for anyone. There are some income limits, like if you make too much money, you can't have the Roth IRA. There are some workarounds, which I'll mention in a minute. But this is an account where you open it, you put after-tax money in it, so you pay out of your paycheck, you contribute money to your Roth IRA, and then whatever you buy in the Roth IRA is basically tax-free forever. So even if you invested in like Apple 20 years ago when it was not what it is today, and you're probably like multi-millionaire on a small investment now, you would normally pay at least 20% in capital gains tax on that profit. So imagine like you invest 100,000, it turns into 10 million, and you have to pay 20% capital gains tax on that entire gain. I mean, that kind of hurts, you know. But if it's in a Roth IRA, you don't have to pay any taxes. So that's huge. It means you can make as much money as you want with your investments, and you'll have tax-free retirement. That's something that people maybe forget to factor in retirement, is that if you have a nest egg and you can take a certain amount of money out of it, that the amount of money that you take out of it, you have to pay taxes on that money. So you actually maybe don't have as much for retirement as you thought because of taxes. And I would like to add, with the way the government is, usually tax rates go up, they don't go down. We are moving towards more like, you know, people want more social programs and things like that. So generally tax rates go up, not down. So think about that. If taxes go up from here in retirement and you don't have a tax sort of a Roth IRA type account, then it's a lot of uncertainty for you to deal with. So I really like the Roth IRA. You can contribute $6,000 a year max, and you should absolutely max it out if you have one. So that's where I would start. Now, most people who have corporate jobs, because I'm sure there's some of you on here as well, you probably have a 401k, and so your employer gives you a 401k, and you should max that out up to the employer match, because that is free money. And then on the side, additionally, open a Roth IRA. So if you're working in corporate, that's the ideal solution: a 401k plus Roth IRA. Max out the employer match in your 401k and have the Roth IRA and max that out as well. And if you are an entrepreneur or self-employed like me, then the ideal combination is to have sort of your own 401k and a Roth IRA. So what do I mean by this? You can open your own 401k. So instead of having a boss that gives you a 401k, your company, your business will sponsor the 401k for yourself. That's called a solo 401k. I'll talk about where to open these accounts in just a minute, but there's some paperwork involved, and you're basically creating a 401k plan for yourself. And it has all the same tax treatment and contribution limits, but obviously you don't get that employer match because there's nobody giving you free money. You have kind of solo 401k substitute for entrepreneurs is the SEP IRA. Now, and the SEP IRA is really nice because you can contribute up to 25% of your income in there. So you can, if you can afford it, you can really put away a lot tax-free for retirement. And the SEP IRA is a little different from the taxation. The taxation is a bit different from a Roth account because you put in pre-tax money. So you can get an immediate tax deduction for anything you put into the SEP IRA. And then when you take money out and make gains on your investments, that's when you pay taxes. So if your primary concern right now is to get tax deductions on your income right now, then a SEP IRA is a good way to do it. But keep in mind, you will have to pay those taxes eventually later on. So those are the 3 types of accounts. Are there any questions about these accounts and how they work and like what would be the best for you? Let me see if I can find the chat.
Yeah, there's a few questions in the chat if they're relevant to what you're covering now.
Okay, let me look for them.
If you see the I can read them if that's helpful since you're sharing your screen.
Oh, I found it.
Okay, good.
Okay. All right. So Deborah Null, hi Deborah. She says, I thought Roth IRA was taxed when you put the money in, such as when you transfer a 401k to a Roth. Yeah. So the Roth IRA is taxed when you put the money in, right? So let's say you are putting $6,000 into your Roth IRA this year. You've already paid taxes on that money. It's like you got your paycheck, all the taxes were deducted from it, and then you pay into the Roth IRA. And then later on, you don't have to forget about tax. You don't have to worry about taxes ever again after that one time of paying the taxes on the contributions. So the way to think about it is a Roth, anything with a Roth, the word Roth in front of it means you pay the taxes going in and nothing going out. And anything without the word Roth in front of it, you don't pay the taxes going in, so you get the tax benefit up front, but you pay the taxes eventually in some way, shape, or form later on. So it's like, if that makes sense. Okay, and so does that answer your question, Deborah? I can't see you, but I'm assuming that it does. Yeah, you can respond to me in the chat because I can't see all the videos. So Ali Felix is, okay, great. So Ali Felix asks, what is the benefit of opening a Roth IRA instead of just putting more into your company 401k? Okay, that's a great question. I'm really glad you asked that. So the one benefit of the 401k that kind of trumps everything else is the employer match. And at my old job at HSBC, every dollar that I put in, HSBC put in $3. So it's like, hello. I mean, I was able to save 4 times as much just because of employer match. Obviously, there's a limit to that. Like, they'll only do that up to a certain amount, but that is the benefit. Like, even if it's 50 cents to a dollar or a dollar for a dollar, you need to max out your employer match. So until you're doing that, don't even worry about the Roth IRA. Once you're maxing out the employer match and getting all that free money, then I want you to prioritize the Roth IRA. And there's a couple of reasons why. The first is that the 401k is not a plan that you control. It's your company's plan, and they have an administrator that runs the 401k for you. And they give you very few options in terms of the investments that you can put your money in. It's usually a couple of target date retirement funds, a couple of different mutual funds, and that's it. So you have very, very limited options. So that's the first reason why I don't like it, because you're restricted to what they want you to invest in. Another reason is they may charge a lot of fees. Like 401k plans charge fees, and it's different for everyone. It depends on what company you're with. But if there's a lot of places that charge a lot of money for 401k fees, and it kind of sucks because you're basically a prisoner customer and you can't take your money elsewhere. So that's why, I mean, like, these are a lot of downsides to the 401k, but because of the employer match, it's worth it. But without the employer match, it's not really worth it, because the Roth IRA is an account that you open under your name. There's no middleman. You control it. You have unlimited investment options, and I like that. Like, the reason why I like investing on my own is because I feel like I'm in control of my own money, and I get to choose what my money is invested in. And the 401k doesn't really give you that flexibility. So that is it. Hope that answered your question, Ali. Awesome. Yeah, I can see you here. Okay, Michaela, would you rather max out your 401k to the 19,500 or do the employee match? Okay, yeah. So I think I just answered that question. Max out your employer match, then max out your 401. I'm sorry. Max out your 401k employer match, then max out your Roth IRA, and then if you have extra money to put away, you can consider opening a taxable account, or you can go back and max out the rest of your 401k. It's really up to you. Okay, so I think that's it for questions on this section. I'm going to move on. Where to open? So Roth IRA, I like Fidelity or Vanguard because we're talking about index funds, and those are kind of the two big index fund houses. They're actually companies that run their own index funds. So if you open a brokerage account with them, you get really good treatment and special fees and just good treatment on when you buy their index funds. So it makes sense to open your account at a place that can offer you the best index funds with no fees. So that's Fidelity or Vanguard. Same with SEP IRA, Fidelity or Vanguard. If you're going to do index funds, really, really don't go anywhere other than Fidelity or Vanguard. And then for the solo 401k or the solo Roth 401k, you don't really have a lot of options there. From what I found, the only place to open it without like driving yourself crazy and having to hire your own lawyer to draft up documents and all this crazy stuff is E-Trade. You just fill out an application. The application is kind of long, but it's all like set up for you. And so that's where I have mine, and that's the place that I found is the easiest. And also, I just want to comment about robo-advisors. So you can open a Roth IRA at a robo-advisor, which is basically a financial advisor that is digital, so they're more cost-effective, where basically if you use one of these robo-advisors, you won't have to do anything that we're going to talk about going forwards in this presentation, because they do it all for you. They'll just ask you what your investment goals are, how old you are, blah, 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 and create a prepackaged portfolio of index funds for you. So that's like having a financial advisor. You don't have to do anything. But what we're talking about in this presentation is how to do it yourself. So Fidelity or Vanguard are like do-it-yourself platforms, whereas robo-advisors, Betterment, Ellevest, Wealthfront, Acorns, they're like done-for-you platforms. So even if you are planning to go with robo-advisors, maybe like after this presentation, you're like, okay, I don't even want to do that. I just want someone to do everything for me. Then great, like go with the robo-advisors, but at least you'll have an understanding of what they're doing with your money, because that's what we'll be talking about. Can you do a quick overview of what an index fund is? Yeah, I will talk about what an index fund is, actually in the next section. So let me go back to this question. What's the difference between a solo 401k account and a SEP IRA account? Right, okay. So this is a good question. Deborah asked, what's the difference between a solo 401k and a SEP IRA? The taxation is the same. You put money, pre-tax money going in, so you get a tax deduction upfront when you contribute, but later down the road, you pay on the gains and the profits and withdrawals. So there is similar in the taxation. The differences are that a solo 401k allows you to contribute, the contribution limits are different. So with a solo 401k, you can contribute up to $19,500 a year. With a SEP IRA, you can contribute up to 25% of your net income. So depending on what's better for you, you can decide. Also, a solo 401k is a little more of a headache to open than a SEP IRA. Like my application for it was like seriously like 40 pages. And I had to call them and ask like, how do I answer this? How do I answer that? It's just not as straightforward. A SEP IRA, you can open in like 2 minutes. So that's kind of the summary. All right, and actually to open an IRA, it's super easy. You just go to fidelity.com or vanguard.com. You click open an account, and then you decide which account you want to open. And if it's not on here, you just go to see all accounts to look at their other options, and that's where you'll find the SEP IRA and other types of accounts. So it's really, really, really straightforward. Next, so choosing your investments. First, okay, let's talk about index funds. So we all know we're all interested in investing in index funds. What is an index fund? So an index fund it's like a basket of lots and lots of different stocks. And let me rewind here. An index fund is a type of mutual fund, and a fund is basically a collection of lots of stocks. One stock. For example, if you wanted to start investing, you could either buy stock in one company or in several companies that you think will do really well because you've researched them, or you can buy stocks by buying a stock fund. And a stock fund will have usually hundreds, if not thousands, of different stocks in it. So the question is who decides what stocks are in that fund? And that's where the whole idea of the index fund comes in. Because traditionally funds were big baskets of lots of different stocks that some really smart guy, usually, yeah, it was back then, it was probably most definitely a guy, he would choose which stocks go in that mutual fund. He would do his research and say like, I know what I'm doing, and these are the stocks that I think should go in this fund. But then later on, index funds came around where someone was like, wait a minute, we're paying this guy a lot of money to pick like the best stocks for our fund, but he's not even performing better to warrant those high fees. And actually, if you just put your money into an index, which I'll explain in a minute, an index is basically like a barometer of the stock market. So the S&P 500, the Dow Jones, the NASDAQ, these are all indexes. And it's just a group of investments like the S&P, and there are rules for what is in that index. Like the S&P 500 index, for example, is the 500 largest companies in the US. So by market capitalization, they are the largest. That's why they're in the S&P 500 index. The Dow Jones is the 30 US companies that have been around for a long time. But basically, An index fund is going to be a fund that instead of paying some really smart guy to actively pick stocks for the fund, it's just going to buy whatever is in the index. So does that make sense? Any questions? If there's no questions in the chat, I'll move on and assume that you understand. Hopefully that was a good explanation of index funds. Yeah, Helen, does that answer your question? Yeah, okay, awesome. Okay, so that's what an index fund is. And I'm going to be showing you on my screen share, like what an index fund looks like, but we'll look at a fund summary page and everything. So that's coming. Yeah, so step 2 of investing, once you've opened your account, your brokerage account, step 2 is to choose your investments. And before we get into looking up index funds and researching and trying to figure out which ones are the best ones, we need to rewind a little bit and start with an asset allocation strategy. So what that means is before you go in to start looking up index funds and clicking around on all these links, I mean, because you're going to get totally lost if you just start doing that, because there are lots and lots of index funds out there. There's so many options. And if you don't have a way to sort of filter through them first, then you're going to not get anywhere. So the first question to ask yourself is, what asset allocation is appropriate for me? And asset allocation is basically the mix and balance of stocks versus bonds and other asset classes that you have in your portfolio. And really the rule of thumb is, if the younger you are and the more you need, the more money you need to get from A to B, the more risk you should take, and the more growth assets you should have in your portfolio versus stable assets. So stocks are what provides growth. However, they are also more volatile. Bonds are what provide stability. However, they don't grow at all. They just pay a small return, the interest. So asset allocation is basically, it's an art and a science where you balance your desire for growth, but also the need for stability. And really, like, if you think about it, a young person doesn't have much money. They really need to make more money to accumulate that nest egg. So for them, it's more important to focus on growth assets, specifically stocks. And an older person who is like 70 and she's gonna be living off her nest egg in a couple years, she should have done all the growth when she was younger. Now she needs to prioritize stability. So the asset allocation for a young person versus old person, or someone who needs their money in 2 years versus 30 years, regardless of how old you are, really comes down to asset allocation. I had this slide for what is asset allocation. Yeah, so basically asset allocation is you balancing your desire for growth as well as your desire for stability. Another reason why asset allocation, something else that asset allocation does for you is it eliminates the need for you to predict what is going to be the best investment. Economic environments when bonds were outperforming stocks. Like right now as an example, like if you look at a chart, stocks are not doing very well right now. Bonds are doing well because bonds are what people all want to buy when everything is scary in the world. However, as you know, from 2000, like the last few years in the stock market have been crazy, crazy good. So stocks have vastly outperformed bonds. So there's an environment when an asset class is doing well and doing bad, and we don't know what environment is coming next. Like everything in the next, like right now, maybe like we all want to be in bonds because it feels safer, but what if the economy turns around and gets like, the stock market goes up like 20% over the next few months? Now, if you were in bonds, you completely miss out. So the idea is, instead of trying to figure out what asset class should I be in now, should I be in cash, should I be in stocks, should I be in bonds? No, you just spread out your eggs among all the different asset classes and there are like recommended formulas for percentages that are advisable. But the basic idea is that with an asset allocation, you have every asset class in your portfolio has a weighting that is large enough to matter, but not so large that it matters too much. So does that make sense? Any questions about asset allocation? Okay, cool. So as I said, the more time you have, the more aggressively you want to invest. And like, obviously it would be great if we could just invest 100% in stocks because that is what's going to grow the most. However, the problem is stocks are extremely volatile. I'll show you, I have a cool graph. Well, I'll show you in a second, but stocks from any given year, it could be up 20%, down 20%, it could be up 50%, it could be down 50%. Year by year, stocks are very, 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 very volatile. And so if you have a 100% stock portfolio and you've never invested before, like, you need to be prepared for your stock portfolio to fluctuate that much year by year. However, over the long run, it goes up. So the reason why you have asset allocation is not only because it's smart and sound, but also it's for your emotional comfort. Because it's a lot easier to see, like, you know, in the last 2 weeks, the stock market has gone down from the highs almost 30%. It's a lot easier to watch your portfolio go down only part of it and the rest is doing well because some of it was in bonds versus seeing all of it tank with the market. So that's a big reason for asset allocation also. It provides emotional comfort. So the basic rule of thumb is that you subtract your age from 110, and that's how much you would own in stocks. So for example, if you're 30 years old, 110 minus 30 is 80. So the advisable allocation that you should have in stocks is 80%. The rest, 20%, is in bonds. That's like a rule of thumb. This is created by Jack Bogle, who's the founder of Vanguard. That's sort of a rule of thumb that pretty much every financial advisor also subscribes to. Okay, so any questions about asset allocation before I move on into index funds and how to pick index funds? Okay, it seems like we're good. Okay, so how to pick good index funds. So first of all, a good index fund isn't the index fund that makes the most money, because we don't know what stocks are going to do, and because it's not an active manager who's picking the best stocks, you're not really concerned about which index funds are doing the best, because the index funds that are doing the best right now, they're probably not going to be doing the best tomorrow. Like, things change all the time when the economic environment changes. So we're not trying to chase performance here. We're trying to go in with an asset allocation strategy and then find index funds to fit that asset allocation. Because otherwise, if you're trying to find the index funds that are going to do the best over the next year, then you're chasing performance, you're trying to time the market, you're being an active investor, which is not what we're doing here. So the question is, what is the best index fund? It's not the index fund that is doing the best right now, because that's no promise that it will continue to do well. What we're looking for is, does that index fund fit into the asset allocation that I want to build? And then also, does it fit some other criteria, such as what I have listed on this slide? Number one, the fee, the expense ratio. You need it to be low cost. Because it's an index fund, any index fund should already have a low fee because there's no active management. A good rule of thumb is an index fund under 0.2% expense ratio. So let's actually look at an example. This is one of Vanguard's most popular funds, their Vanguard Total Stock Market Fund. The expense ratio is, as you can see, very low. Can you all, okay, you can all see my screen, right? So the so here the expense ratio is 0.04%. That means that if you invest, I don't know, $1,000 into the fund, you're gonna pay, what is it, $4? No, 40 cents? Whatever 0.04% of 1,000 is, that's what you pay every year to the fund in order for you to be invested in that fund. A lot of active funds, like non-index funds, charge like 1%, 2%. And over time, when you really compound these fees over 20, 30 years, it adds up, it takes off like tens of thousands of dollars off your nest egg. So you want to keep your expense ratio as low as possible. So that's the first criteria. If it's a low cost, low expense ratio, ideally anything under 0.2%, it passes that test. The second criteria is what's the tracking error? So the tracking error is the difference between what money the fund makes versus what the index that it's benchmarked against, what the index makes. So obviously, if I'm investing in an S&P 500 index fund, if the S&P 500 index has gone up by 10%, then I would hope that my index fund has also gone up by 10%. There should be no mismatch. Because and a mismatch shows, or like the size of the mismatch shows how well the fund, how good of a job the fund does at replicating the index. And you can see that here in the performance tab, price and performance. Just look at, so here, this is the index that it tracks. These are the returns of the index, and these are the returns of the fund. And they're like pretty much side by side, they're the same. So that's what we want to see, minimal tracking error. And then the next factor is dividend schedule. This is where Fidelity and Vanguard differ a little bit. A lot of Vanguard index funds pay on a quarterly basis the dividends. So as you can see here, they've paid dividends every quarter, on the 3rd, in March, December, September, June. Whereas Fidelity will pay most of their dividends on an annual or semi-annual basis. So anyway, depending on how often you want to get your dividends, that's one minor factor. And just as a resource for you, and I think Hannah will give me a way to send you all these things, is my Fidelity Index Funds cheat sheet. I don't have one for Vanguard. This is a cheat sheet of the best index funds for Fidelity, and it sort of has a quick description of what it is and what's good about it. So I'll tell you guys how to get that, or Hannah will tell me. But the reason why I like Fidelity is because they don't have any investment minimums. A lot of Vanguard's index funds, you have to have at least $3,000 invested, whereas Fidelity has no restrictions whatsoever. So I find it to be better for beginners when they're just starting out and just want to get started with a smaller amount of money. So anyway, and so step 3 is to pull the trigger. Once you've opened your account, you've decided on your asset allocation and picked the index funds that build that asset allocation, the next step is to finally go in and place that buy order. And a question that I get a lot when it's time to do this is whether you should invest all your money in a lump sum or invest gradually. So the rule of thumb is, because the stock market goes up over time, the more you invest now, the better. So from a statistical probability-based point of view, investing the lump sum results in a bigger nest egg most of the time. However, if you're very unlucky with the timing and you invest your lump sum at the top of the market, then you would have been better off investing in chunks, like little bits at a time. So my advice is to just invest gradually, because even if you got lucky, like right now, maybe we are at the bottom of the market, you invest all your money right now and it just goes up from here, you're going to be really happy. However, if this is not the bottom of the market and nobody knows that, and you invest all your money right now and then everything goes up even more from here, because it could, I don't think we've seen anything yet, then you're going to be so upset. You might even pull all your money out and really the emotional shock of just having all your money in the market all at once, all like a lump sum. I think that's very, very jarring and could reduce the chance of you making more rational decisions. So that's why I always advise investing gradually. So if you have, I don't know, $10,000 right now that you want to invest, I would advise splitting that up into 4 chunks, like $2,500 each, and setting a schedule. Like I'll invest now, I'll invest $2,500 now, I'll invest another $2,500 in 3 months or next month or next week, whatever the case may be, but to do it gradually. So that's kind of my advice. All right, and now I'm going to talk a little more about the psychological and emotional and those kind of barriers to become a successful investor. The first is that I just want to throw it out there. I know it's hard, finance is still very much a man's world, and I think that really sends off a subtle message that for whatever reason, that must mean women don't have what it takes to be good at investing. And that's absolutely not true, because index fund investing doesn't take a finance degree. It doesn't take any sort of judgment. like there's a set of rules for what asset allocation is good for you, and it's pretty easy to find out which index funds fit that asset allocation. Like this is stuff that is not hard to do, and I think the financial industry really puts a lot of money into making it look hard. So it's not hard. You can do it yourself. There's principles that you can follow. But where it really, really gets hard is when the market crashes. That's the hardest part. Like it all sounds good in theory, but the buying and holding, yeah, stay the course, it's easier said than done, because when you're in it, it's very, very emotional. So it's always tempting. You invest, it goes down, you see your portfolio fluctuate. It's tempting to just sell and get out, and just then you can feel safe because your money is just in cash. And I think no matter how experienced you are still going to have that temptation. But whether you act on that temptation, what stops you from acting on that is understanding the facts. So what are the facts? Because I firmly believe if you can make decisions based on facts, not emotions, you will succeed at investing. When you panic after a market crash and then you just sell everything, what happened there is that you've locked in your losses, because a paper loss is very different from an actual loss. Because if your portfolio has gone down but you still own those investments, it's a paper loss. And paper losses reverse. Like they've already reversed a lot in the last week, because the market's going back up recently in recent days. However, if you sell, then you're not in it for the recovery. So then you've really locked in your losses. So 100% of the time, it's better to hold on and make a decision. If you are going to sell, don't do it when you're panicking. Do it after everything is calmed down and you can think clearly. But general rule is don't sell until you reach your goal, really. And here's a very graphic example of what happens when you sell. Like you get in and out and make emotional decisions. Well, actually, before I get into this slide, something that I want to tell you guys is the stock market has in any given year, there's a few very, very strong trading days. It's usually like every day the market goes up a couple points, down a couple points, but there's a few days out of the year where it goes up like a lot, way more than is usual in a daily trading day, in an average trading day. And those few days are what are responsible for the majority of your returns as a stock market investor. And nobody knows when those days are going to be. It's like a couple days out of the year are responsible for the majority of your returns. And if you miss even just one of those days, that really hits your returns. And so what I'm getting at is, instead of basically, you don't know when basically just stay in the market the whole time. Just stay in, because if you try to pick and choose and optimize and get in and out when it feels safe for you, then you're really going to end up hurting yourself in the long run. And this is a very good example. This is a chart that shows right here, if you had invested $10,000 into the S&P 500 index starting in 1980, you would have that $10,000 would have grown to $659,000 today. Whereas if you miss just 5 of the best trading days, just 5 in that 30-year period? No, I cannot do math. 40-year period. Then you're, instead of 659,000, you actually only have 427,000, just from missing the 5 best days. And then if you miss the 10 best days, it goes down even more. If you miss the 50 best days, you could have had 659,000, but instead you only have $57,000. So that's the impact of being out of the market when you don't know when really is a good time to be out of the market. And nobody knows when is the best time to be in and out of the market. If we knew that, we'd all be bajillionaires. So that would hopefully that will sort of help you think twice before you panic sell. Like once you're invested, you got to stay invested. Another fact that I think is very, very powerful is this chart, which shows the S&P 500 returns over different time periods. So if you, in a 20-year period right here, the S&P 500 has generated a positive return 100% of the time. If you invest into the S&P 500 for one day, there's basically a 50-50 chance that you'll make money or lose money. because 54% of the time it was positive, 46% of the time it was negative. If you invest your money for 1 year, there's a 74% chance that you'll make a positive return and a 26% chance that you'll make a negative return. So as the time horizon expands from 1 year to 5 years to 10 years to 20 years, the chances that you'll make a positive return go up and the chances that you'll make a negative return go down. And 20 years is the magic number. Actually, it's more like 16 if you get more granular. But if you plan to hold your investments for 20 years, there's a 0% chance that you'll make a negative return and a 100% chance that you'll make money. I think that's really powerful. So basically your edge as an investor is to buy and hold for the long term. And that's how you can basically guarantee that you won't lose money and guarantee that you'll actually make money. I'm gonna look at questions now. Where's the chat box? Hannah, can you read me the question in the chat?
Yes. Please share the previous slide with the difference of missing the 5 days.
And Hannah, are you going to send the slides to everyone?
Yes. So you and I can chat about that after the call, but so everyone knows you will get the slides in some way, and we're going to talk about that after. So, yeah.
Okay. Great. And then here's a cool little GIF that I found that shows the returns in 1 year, 5 years, 10 years, 20 years. Basically, the longer your time horizon, the more green you start seeing and the less red you start seeing. So in a 20-year time horizon, even if you invested during the Great Depression or like during the 2008 financial crisis, if you had a 20-year period, you made money. Okay, so that's pretty much it for my presentation. Are there any questions? I'm going to look for that chat box. And instead of the chat, we can just have people call out. Hannah, is that okay?
Yep, that's perfectly fine.
Ooh, okay. Anna asks, maybe this is not exactly about investing, but during our current situation with the Feds printing money, is there a risk that money loses its value like it did during the Great Depression? Is there anything we can do to protect ourselves from this? So Anna, you're asking, with the Fed printing money, is there a risk that money loses its value? Oh, so you mean like with hyperinflation, I'm assuming? Yeah, okay. So this is kind of complicated. I actually made a YouTube video about this. I'll include that also in the follow-up resources. But yes, the Fed is printing money, but right now there's in a vacuum, if you just print a lot of money, that's going to cause a lot of inflation. But the Fed has actually been printing lots of money since the 2008 crisis. That's what helped us get us out of that crisis, out of that recession. And it's not inflationary if the printing money substitutes a decrease of money circulating elsewhere. So in 2008, a bunch of companies, they had bad mortgage debt, and then that mortgage debt just disappeared. So people who had assets and there was a lot of credit that was circulating in the economy that stopped circulating. So basically the circulation, the amount of money circulating in the economy in the form of credit kind of really contracted. So the Fed stepped in to print money and substitute that lack of money circulating in the economy. So basically when that money printing is substituting something, then it's not hyperinflationary. What happened in Germany during the Weimar Republic and during the Great Depression, there's a number of reasons. Germany's currency was not a reserve currency. There were a lot of different reasons. So basically, is there anything you can do to protect yourself from this? I firmly believe you need to invest in equities, stocks, because stocks, they are what will help you hold your money, preserve the value of your money against inflation. And That's it. And I know there's a lot of doomsday scenarios and people who really predict about the US dollar going, you know, becoming, or like the US government basically falling and all this stuff. I mean, if you want to be if you want to think in that way, then you're welcome to invest in gold and cryptocurrency and like go the extreme route. But based on the evidence, based on the history, equities are the best place to invest, and regardless of what happens, regardless of inflation, deflation. So that's kind of my answer. But I have like an economics 101, how bad can this recession get kind of video on my YouTube channel. So I'll share that with you in the follow-up resources. Okay, so Helen asks, this might be a little specific, but would you recommend someone starting out their financial planning and investing to have a savings account in addition to an index fund? Okay, all right, this is great. I'm really glad you asked this because before you start investing, it's really important to have emergency savings that you can tap into if you get laid off or something crazy bad happens, if you get sick, because you don't want to ever have to sell your investments because you need the money. You want to sell your investments because you want to sell them. Because usually when you have to sell your investments, if you're in a position where you need to come up with cash and you got to sell your investments, it's probably not a good time in the market to do that, such as now. Like, let's say you didn't have an emergency fund, you started investing, and now this whole recession, coronavirus thing happened, and you got laid off. Now you don't have any money to live off of. Now you need to cash out your IRA or your 401k to live. Then you've had to sell your investments after a 30% drawdown in the market. So you never want to have to do that. You always want to have at least 3 months, ideally more, of emergency fund savings in a savings account. So that's kind of your cash buffer. Because like I said, if you can stay in the market for 20 years, you're going to be good. All right, so thanks for that question. That was really awesome. And then Anna asks, only stocks or stocks and bonds? Oh, okay. Basically stocks and bonds. The bonds are to really balance out the stock portfolio. Okay, and I just want to leave you with one more thing. I have a full-on course that takes you through all the step-by-step of everything we talked about. I do a lot of screencasts. I talk more in detail because there's a lot more considerations, and I could only cover a certain amount in this course. So it's called Automatic Millionaire, and it shows you exactly how to build and manage your index fund portfolio, and it's targeted perfectly for beginners. So if you want to check it out, I have a special offer for dreamers and doers. You can just go to that link, bit.ly/DD course offer, and use the dreamers doers discount code. The original price is $297, and in the discount, you can just have it for half off. So that's kind of my special offer just for you guys. I'm launching it to the public in a couple of weeks, but just wanted to give you guys a sneak peek. So that link will show you take you to the sales page and tell you all about it. And that's it for today. These are my social channels. You can also email me personally at rose@roseshafa.com if you have any questions, or obviously on Facebook messaging through our D&D group. So I would love to connect with you. Please stay in touch. And I'm really hoping you guys stay safe and healthy and make the best of all of this.
Thank you so much for everything. This was incredible. Thank you all so much for tuning in. I hope you have an amazing rest of your day, and hopefully I'll see you virtually very soon on another call.
Bye. Thank you all.
Bye.
Bye. Thank you so much.
You're welcome.